Welcome to Cloud9 Trading. This is Shaibu Mama. Today I'll be sharing with you a secret strategy or a tip that will make you profitable. What I'm actually going to share with you is a secret that your mentor will be charging you hundreds of dollars just to teach you. What I'm going to share with you today will actually make you profitable. It will help you know when to stay out of the market and when to be in the market. In today's video, we'll be doing intermarket analysis that will try to understand how movement in one market affects movement in another market. We'll be using the cryptocurrency market in the United States dollar index. The dollar index is dominated by a symbol DXY, and then the index is basically a tool that is used to measure the strength of the United States dollar relative or as compared to a pool of other 6 national currencies. And these 6 currencies include the British pound, the euro, the Canadian dollar, the Japanese yen, the Swedish krona, and the Swiss franc. So when you see an upward movement in the index, that's the dollar index, it is basically telling you that the dollar is gaining strength relative to these other 6 currencies. And when you see a downward movement in the index, and it's also telling you that the dollar is losing strength relative to these other 6 currencies. So you can see a pie chart beside me that is explaining the proportionate share of each currency in the pool. Basically, how market cycle works is that during a boom where the economy is doing well, everything is fine, people are happy. So when people are happy, they become optimistic. And when they are optimistic, they become risky. They are willing to take risks, and thereby looking for a high risk investment where they can get high returns. So in those periods, the people mostly channel their money into stocks, cryptocurrencies, bonds, and other riskier investment. And during a period of uncertainties, people do the reverse. Instead of channeling their money to risky investment, they channel their money to less risky investment like cash. They start saving money, or they start buying precious metals like gold. So the cryptocurrency market being a risky market, and the DXY being, that is cash, saving cash, being less risky. We'll try to understand how the movement in the DXY affects movement in the cryptocurrency market. So without wasting time, let's go straight into the chart and view historically how the movement in the DXY has been affecting movement in the cryptocurrency market for the past decade. So let's go straight to the chart and see what is happening.
I'm all about stacking up my Bitcoin. Cash is the past, got my Bitcoin up. Cash is the past.
All right, we have our DXY chart and our Bitcoin chart lying side by side. Our DXY chart is the one in dark background, and our Bitcoin chart is the one in light background. And this green areas means a rising market, and the red area means a falling market. So let's get started, and we'll be doing our analysis all the way back to 2013. And from 2013, this is our DXY chart in 2013. When we come to around March 2013 to March 2014, our DXY was falling. And when we come to that same period, January 2013 to January 2014, Bitcoin was rising. So first, there's an inverse relationship between the two. Take note of the relationships as we go on. You get to understand what I'm trying to explain to you in this video. And after 2013, that is from April 2014 to May 2015, DXY was rising. And in that same period, March 2014 to May 2015, Bitcoin was falling. Have you seen the relationship again? When you come to 2017, from December 2016 to February 2018, our DXY was falling. And in that same period, November 2016 to February 2018, Bitcoin was rising. Another negative relationship. And when you come to our DXY chart again, from March 2018 to March 2020, our DXY was rising. And in that same period, from February 2018 to March 2020, Bitcoin was falling. Another inverse relationship. And when you come to the current trend we are having, when we come to the period between April 2020 to July 2021, our DXY was falling. And in that same period, when you come to our Bitcoin chart, in that same period between April 2020 to July 2021, Bitcoin was rising. Another negative or inverse relationship. And currently, you can see our DXY is going up and Bitcoin is coming down, which is telling you that time and time again, that is a period of about 8 years, DXY and Bitcoin has been building or is having an inverse relationship. So anytime for the past 8 years, anytime DXY is going up, Bitcoin will start falling. And anytime DXY start falling, Bitcoin will start rising. And it's not a coincidence they are having this relationship. Why? Because we use cash to buy cryptocurrencies. When people start moving into cryptocurrencies, it means that they are going out of cash. And when people start liquidating their positions on cryptocurrencies, it means that they are going back to cash. And when you are going out of cash to cryptocurrencies, that means you are buying more cryptocurrencies. It will start rising. The prices will start rising. And you are leaving cash. And when you start liquidating your cryptocurrency positions back to cash, the cryptocurrencies will start falling, whilst cash will start rising. And that's the relationship they are trying to build, or that's the relationship these two are having. So understanding this relationship will actually help you to always be at the right side of the market when you are making your investment, so that you won't be the one to be buying the top and selling the lows. So thank you for watching this video, and I'll see you in the next video. But don't forget to subscribe and leave a comment on any other topic you would like me to discuss in my next video.